Today, no Fed put for you or you. Hello again, it's Martin North from Digital Finance Analytics with another post covering finance and product news with a distinctively Australian flavour. Well, Wall Street's three major indices all closed lower on Tuesday, following a rally last week as volatile oil markets kept soaring inflation in focus and investors reacted to hawkish comments from Federal Reserve officials. After outperforming earlier in the session, the S&P Energies sector also lost ground after a report that some producers were exploring the idea of suspending Russia's participation in the OPEC Plus production deal. Federal Reserve policy was also top of mind for investors as US President Joe Biden and Fed Chair Jerome Powell met on Tuesday to discuss inflation, which Biden has said ahead of the meeting was his, quote, top priority. That was after Fed Governor Christopher Waller said on Monday that the US Central Bank should be prepared to raise rates by half a percentage point at every meeting from now on until inflation is decisively curbed. The market's trying to figure out the end game for the Fed, said Jack Janasiewicz, portfolio manager at Naxos Investment Management Solutions. And while lower commodity prices would be good news for equities in the longer term, the impact of the report about OPEC and Russia on the energy sector may have spooked the broader market as well on Tuesday. That's the sort of thing that was the market on the edge, he said. When we started out, the sector leading us higher was energy. By the session's close, the biggest decliner among the S&P's 11 major industry sectors was energy. It was down 1.6%. The only sector gainers were consumer discretionaries, up 0.8%, with Amazon, the S&P's biggest boost from a single stock on the day, and communication services up 4.4%, despite Jefferies trimming its price on the e-commerce giant to $3,250 from $3,700, citing concerns about an economic slowdown. Google was the S&P's next biggest contributor, up 1.29%. So the Dow Jones Industrial Average fell 0.67% to 32,991. The S&P 500 lost 0.63% to 4,132, and the Nasdaq Composite dropped 0.41% to 12,081. All three indices had rallied last week to snap a decade-long losing streak. With Tuesday's decline, the S&P and Dow are essentially unchanged for May. The Nasdaq showed a monthly decline of 2%. There are too many concerns at the moment for markets to do a sharp V-bottom, said Carol Schilleff, Deputy Chief Investment Officer at BMO Family Office, who sees equities trading sideways for some time due to uncertainties including the Russia-Ukraine war, the global economy, and inflation, as well as Fed policy. A piece of it is energy prices, because at the margin, those really impact people's propensity to spend. People are really noticing the higher prices at the grocery store, she said. Earlier in the day, data showed that US consumer confidence eased modestly in May amid persistently high inflation and rising rates, while a separate reading showed US home price growth unexpectedly heated up to record levels in March. The Conference Board's measure of consumer confidence fell to 106.4 in May from 108.6 in April, which beat economists' forecasts of a reading of 103.9. Consumer stocks sensitive to China, including Nike and Starbucks, were also in the ascendancy as Shanghai ended its 2-month-long COVID-19 lockdowns, at least for now. Tech, meanwhile, ended off the lows of the day amid a mixed performance from big tech following pressure from climbing Treasury yields. Apple was higher, while Microsoft and Facebook both ended the session in the red. Energy cut its gains after oil prices slipped on reports that OPEC members are considering suspending Russia's participation in the oil production deal. This could potentially pave the way for other OPEC members, including Saudi Arabia, to increase output. The WTI was still higher, up 0.37% to 115.12. The news comes as Russia's crude output is expected to fall after the European Union agreed on a ban on Russian oil imports, well, at least partially, via ship. And in other news, AMC Entertainment fell less than 1% after giving up some gains, despite signs of return to movie demand following a record-setting weekend box office performance by Top Gun Maverick. The positive end to May for the broader market followed a wave of disappointing quarterly earnings from retailers earlier in the month, showing the inflation had squeezed on low-end consumers, and it was stoking fears that the Fed's plan to slow growth could tip the economy into recession. But some on Wall Street suggest that while economic growth will likely slow, bets on a recession could be overblown. We believe fears of declining economic activity this year will prove overblown unless new negative shocks materialise, Goldman Sachs said in a note earlier this week. Well, they would say that, wouldn't they? Key data due out later on includes the latest monthly non-farm payrolls for clues to the labour market. But the sentiment is tinged by the sense that the Fed won't stop its interest rate hikes anytime soon. And as for later, well, who knows? Atlanta Fed President Raphael Bostic, in an interview with MarketWatch, said his suggestion that the central bank take a September pause in its push to raise interest rates should not be construed as any way a Fed put, or belief that the central bank would come to the rescue of the markets. In the interview, Bostic said the notion of any sort of Fed put was never a factor in his thinking. I think it's a good tale on some level for storybooks, but it's not driving how I'm thinking about policy, he said. Financial market conditions have tightened sharply this year as the Fed has started to raise its benchmark rate in the face of the highest inflation reading in 40 years. The Dow Jones Industrial Average was down 9% so far this year, while the S&P 500 is off 13% year to date, and the yield on the 10-year Treasury note moved below 3%, but it was up 0.83% on the day. The 2-year was also higher at 1.37% to 2.5747. Most Fed officials favour the Fed hiking by half a percentage point in the next two central bank policy meetings. That's the one in June and July. But last week, Bostic suggested that a pause in September might make sense, causing some upswing in markets. Bostic said a pause might be a good idea because the market's response to the Fed's shift in raising rates was far stronger than what we've historically seen. This raises the possibility that the broader economy will respond quickly to the Fed's rate hikes as well, he said. I want to make sure I truly understand the pace of change that's associated with our policy response, he said. By September, some of the uncertainty over the economy could be resolved and the labour market imbalance could ease, leading to a pretty significant reduction in inflation, he said. The opposite side of the coin, though, is that inflation could remain higher as supply chains remain broken by overseas events like the war in Ukraine and the COVID lockdowns in China. The Atlanta Fed president said he wanted to see the central bank move its benchmark rate to a range of 2 to 2.5% sometime toward the end of the year. And at that point, if inflation is not moving down in a significant way, Bostic said he would be fully comfortable moving rates higher into a range that would restrict economic growth. The goal is to get inflation down. We've got to really tackle it in an intentional, persistent way, he said. I want to be open to both possibilities. After the expected rate hikes in June and July, the Fed's policy rate would be in the range of 1.75 to 2%. And on Monday, Federal Reserve Governor Christopher Waller pushed back on the idea of a pause in September, saying he favoured half-point rate hikes at the next several meetings. And St. Louis President James Bullard said he wants the Fed to hike rates to 3.5% by the end of the year. For his part, Fed Chairman Jerome Powell said he wants to raise rates until, quote, there is clear and convincing evidence that inflation pressures are abating and inflation is coming down. In the meeting between Powell and President Joe Biden at the White House on Tuesday, analysts said the meeting strengthened the Fed's hand to combat inflation, and investors in financial future markets think the Fed will raise rates by 3% by the end of the year, but then stop. Bostic said he was forecasting that inflation as measured by the Personal Consumption Expenditure Index would slow to just about 4% by the end of the year from 6.3% in April. Minutes of the Fed's last meeting show that the Fed staff projects PCE inflation will be down to 4.3% by the end of the year. Bostic said some of its contacts are reporting the first signs of slower demand, which could factor into the ultimate level of the Fed's benchmark rate, which will be needed to get inflation under control. While not yet a contraction, there is, quote, less willingness to spend freely among certain segments of the population, he said. At the moment, the pullback on spending is concentrated on households who had less wealth and savings going into the pandemic. While there is a lot of aggregate savings overall in the economy, the distribution is split in a way that wealthier households hold more of the savings and can weather higher inflation. As we go further and further on, the number of families that are in that situation is going to fall, and that is why you could see some retrenchment, he said. And Bostic said there is a lot of momentum in the economy. The economy can slow down for quite some time before it would slip into a more recessionary posture, he said. I understand the concern. I don't think we're quite there yet. And Bostic, by the way, is not a voting member of the Fed's interest rate committee this year, and the Fed's policy committee will meet on June the 14th and 15th. Fed officials will stop discussing policy after this Friday, June the 3rd, to prepare for the meetings. And Bostic, who's an expert on housing markets from prior work at the Department of Housing and Urban Development, said he expected housing markets to cool due to higher mortgage rates. In many markets, this cooling will not translate into outright reductions in price, he said. Performance will depend on the economic performance of the local market rather than the across-the-board phenomenon that becomes the norm, he said. And on Wednesday, of course, the Fed will launch its quantitative tightening program to shrink its $9 trillion balance sheet, initially by $47.5 billion per month, and then by $95 billion a month starting in September. That's a little more than $1 trillion in reductions each year. Experts generally expect the Fed to reduce its assets holdings by around $3 trillion. And Bostic acknowledged that there was some uncertainty in markets associated with the impact of quantitative tightening, and the Fed is going to make sure it understands how the markets are responding. We're going to proceed in a steady way, Bostic said. Now, over in Europe, inflation in the Eurozone surged to a new record high in May, piling on more pressure on the European Central Bank to end its money printing and bring its key interest rates back above zero. Preliminary figures from Eurostat showed consumer price inflation rose to 8.1% in the 12 months through to May. That's up from 7.4% in April, and well ahead of the analysts' forecasts for 7.7%. The monthly rise in prices of 0.8% was also above forecasts, which were for 0.6%. The development had been expected already after Germany, Spain and Belgium all reported above consensus figures on Monday. The euro weakened ahead of the release after two senior ECB officials from France and Italy both signalled that they didn't see the numbers as any reason to hike the ECB's deposit rate by more than 25 basis points in July. That's the course that the central bank's president and chief economist both outlined last week. So the euro ended at 1.0730 against the US dollar. The latest major figures for May in France and in other countries confirms the rise that we'd expected and the necessity of a gradual but resolute monetary normalisation, the French official said. Analysts, though, were more forthright. It's another eye-watering inflation number for the Eurozone at 8.1% in May, said Angel Talavera, head of European economics with Oxford Economics via Twitter. He warned that there were clear signs inflationary pressure is no longer contained to high oil and gas prices, which were the initial driver of the current wave, although more than half of it is still driven by energy. Food and services prices are going to be increasingly taking over in the coming months, he said. And that's really the point, because whilst you can try and narrow the focus in on energy and say that therefore inflation can be tamed, when you stand back and see just how far it's now got, percolating through the economy, the inflationary challenge is significant. And to that end, it is certainly likely that both in the Eurozone, in the UK, and in the US, they will continue to hike for some time. The question, of course, will be whether lifting rates will actually get inflation under control, when in fact inflation is to some extent at least linked directly back to supply chain disruptions. This is a bit of an experiment in real time. So we'll see how things go. But the bottom line with regard to the markets is there is no Fed put. Markets will probably go lower from here because until inflation is anchored and rates are anchored, the truth is that the value of stocks are probably still too high. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.